Hey everyone, this is Corey with Sims Investment Management, and this is another monthly market update. And before I jump into anything, I just want to wish everyone a happy Thanksgiving. Hope everyone gets to unplug and enjoy some time with their friends and family. And we will be praying for those of you that I know it's been a hard year, and some of our clients that have lost some loved ones. So just please, everybody, be safe and enjoy the time together. We do have a pretty fun little flow chart that's an attachment that says, "Are you ready for Thanksgiving?" So I encourage you to check that out, and hopefully it gives you guys a laugh, or maybe it even helps a little bit. In October and then into November, the market has recovered fairly significantly off of the rough month that was September. Volatility continues to be in the market right now as the path forward on interest rates is unclear, but getting a little bit of a clearer picture. So I thought this month it would be appropriate for me to talk through a little bit of the way that bonds work and why are interest rates such a big deal. Historically speaking, a lot of financial advisors or financial literature might talk about a 60-40 portfolio. And what that means is 60% of your portfolio is invested in stocks or equities, and 40% of your portfolio is invested in bonds or fixed income. And this has been a common portfolio for many decades for retirees. And we don't necessarily subscribe to that portfolio, and we haven't. We feel like it's an outdated model and has been for a few decades. And that's primarily because of the fact that 40% of your portfolio in a low interest rate environment was a lot of money to essentially have not working for you. So why is there so much volatility right now because of interest rates? Well, when interest rates go up, bonds go down. It's an inverse relationship. And so many clients that I'm finding aren't familiar with this, and so I've been asking, would you like me to explain that a little bit further? So we're going to pick on the 10-year Treasury bond a little bit, and in August of 2020, the 10-year Treasury was trading at 0.5%. So that means that if you bought a $10,000 bond from the U.S. government for 10 years, that they would pay you $25 every 6 months in interest. And $50 a year in interest for $10,000 in a bond is not a lot of money. And so that would be very hard to make any type of an income and live off of that, especially when you consider that at the time, inflation was still running around 2 or 3%. So you were technically locking in what is called a negative real return on that money. Now, the bond market is larger than the stock market, and a lot of people also don't know that. And bonds trade kind of like real estate. They're unique investments versus stocks or equities are more standardized. And so the bond market trades with kind of a wider spread, similar to when you buy a house. There's usually some bargaining or negotiating to get to that middle level that everybody agrees upon. So let's go back to this example again of this bond, and if you bought a bond yielding 0.5%, well, now interest rates are at 4% on that 10-year Treasury. So if I, as a new bond investor, want to buy a bond, I could either go into the market and buy a new 10-year bond that $10,000 is now going to pay me $400 a year or $200 semi-annually in interest. Or if you want to sell your bond you bought 2 years ago, I could buy yours that's only paying me $25 every 6 months. I think it's probably common sense which one you would rather have, one paying you $400 a year or one paying you $50. So if you have that bond that's only paying $50 a year in interest, the only way for you to sell that bond and get your money back prior to maturity would be to sell it at a discount. And those bonds are down roughly 20% right now in 2 years. So if you bought a 10-year Treasury in August of 2020 and you put $10,000 into it in 2020 and you now need that money today, you would only probably get between $8,000 or $8,500 in today's market environment. So hopefully that makes sense and explains a little bit more of how bonds work and why interest rates go into so much of equity pricings and volatility. When interest rates come back down again, we should see bonds go up in value, and it can also then be a good time for stocks because there's less competition for stocks. If bonds are yielding 5 or 6% like they have historically, that creates competition for would I rather put my money in stocks or bonds. If you want to talk about that further, I'd be happy to discuss it with you, but I do hope that that helps a little bit to describe what's going on. I'm going to end this month with a really great quote that Warren Buffett had saying that time is your friend, impulse is your enemy. Take advantage of compound interest and don't be captivated by the siren song of the market. I will leave it there. If you have any questions, if you think somebody would benefit from seeing this video, please forward it along. And have a blessed and happy Thanksgiving, and we'll see you next month. Thanks.